All right, y'all, we have a lot to get to today, but I want to start by talking about the situation in California. So, if you've seen any of the photos or the videos, it is absolutely devastating, absolutely heartbreaking. Many people have lost their homes. Dozens of people, I believe, at this point have lost their lives. It is just a heartbreaking situation. And while many parts of California are still literally on fire while I'm recording this, the insurance market in California has figuratively been on fire for years now. So I want to kick off today's show by talking about the insurance crisis in California, how it started, and how possibly to fix it. So before we jump into the conversation, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe to the show. That way you don't miss any future episodes. And we're going to have a lot of articles and things that you can reference. So if you're looking for the show notes, you can find those at realestatebackstage.com/episode 14. So I want to start with this article from insurance.com. Quote, California's home insurance crisis is ongoing as wildfires have driven big-name insurance companies to stop writing new home insurance policies in the state and sent rates skyrocketing in high-risk areas. The latest outbreak of wildfires, including the Palisades and Eaton fires, underscores the crisis. Pacific Palisades was hard hit by State Farm's decision to back out, with 69% of the company's policies there non-renewed. The California FAIR Plan, the insurer of last resort, saw an 85% increase between 2023 and 2024, Insurance Journal reports. State Farm, Allstate, Farmers, and Safeco all announced decisions to halt or slow the sale of new policies. Other companies that have made similar moves include The Hartford, Tokio Marine, AIG, and Chubb. Recently, State Farm said some policies will only be renewed if the homeowner accepts the policy without fire coverage, while Allstate paused new sales as costs mount, unquote. So I really want to focus most of the attention here on State Farm because that's the company that really has been singled out primarily as the villain of the story. And before I go into too much detail here, let me just preface this by saying nothing that I'm about to say should be construed in any way as a lack of empathy for those who are suffering. I can't imagine what it would be like to be a local on the ground right now in California, to be evacuated, to possibly lose your home, possibly be without insurance coverage. I can't imagine how difficult that situation would be like. I understand there is real world suffering going on. However, in situations like this, people always look for a scapegoat. They're looking for a villain, and typically people will start pointing fingers without having all the information, just based on the narrative that maybe is spun on mainstream legacy news outlets. So I want to talk about State Farm, and while I do own an insurance agency, we own a real estate brokerage and an insurance agency. We do not have a contract with State Farm. We have never personally written any State Farm policies, so I really don't have a horse in this race. Really, I just want people to have accurate information. All right, so this is a press release from State Farm on May 26th of 2023, so almost 2 years ago. Quote, State Farm General Insurance Company, State Farm's provider of homeowners insurance in California, will cease accepting new applications, including all business and personal lines, property and casualty insurance, effective May 27th, 2023. This decision does not impact personal auto insurance. State Farm General Insurance Company made the decision due to historic increases in construction costs outpacing inflation, rapidly growing catastrophe exposure, and a challenging reinsurance market. We take seriously our responsibility to manage risk. We pledge to work constructively with the CDI, that's the California Department of Insurance, and policymakers to help build market capacity in California. However, it's necessary to take these actions now to improve the company's financial strength. We will continue to evaluate our approach based on changing market conditions, unquote. So that was from May 26, 2023. State Farm announced they were going to stop writing new policies in the state of California, and the reasons they cited were historic increases in construction costs due to inflation, rapidly growing catastrophe exposure, so increased wildfires, and a challenging reinsurance market. So a lot of people don't know this, but insurance companies, insurance is basically a way of transferring risk from yourself to a pool through insurance. But a lot of these insurance companies will then also transfer some of that risk onto a reinsurer to help prevent major losses whenever there is a really big natural disaster or a catastrophe. And so when the cost of reinsurance goes up, that squeezes the margins on the insurance carriers that we all think about, like State Farm, Allstate, Travelers, etc. All right, so that was from 2023. Now, this is a press release from State Farm, March of 2024, last spring. Quote, State Farm is working to ensure its long-term sustainability in California. In doing so, State Farm General has had to make some difficult but necessary decisions that will impact a portion of our California policyholders as follows. We will non-renew approximately 30,000 homeowners, rental dwelling, and other property insurance policies. These actions are California specific and will occur on a rolling basis over the next year, beginning on July 3rd, 2024, for homeowners, rental dwelling, residential community association, and business owner policies, and on August 20th, 2024, for commercial apartment policies. Combined, these policies represent just over 2% of State Farm General's policy count in California. This decision was not made lightly, and only after careful analysis of State Farm General's financial health, which continues to be impacted by inflation, catastrophe exposure, reinsurance costs, and the limitations of working within decades-old insurance regulations. State Farm General takes seriously our responsibility to maintain adequate claims-paying capacity for our customers and to comply with applicable financial solvency laws. It is necessary to take these actions now. We also recognize the Insurance Commissioner's proposed regulatory reforms, such as streamlining the rate application process, accounting for catastrophe modeling and reinsurance costs and rates, and addressing FAIR plan vulnerabilities. So FAIR is the state-run insurer of last resort, and that stands for fair access to insurance requirements. We will continue to work constructively with the California Department of Insurance, the Governor's Office, and the policymakers to actively pursue these reforms in order to establish an environment in which insurance rates are better aligned with risk, unquote. So that is really the crux of the issue. The rate that they were allowed to charge by the state of California was no longer aligned with the risk. So a lot of people don't know this, but insurance is incredibly heavily regulated at the state level. So in order for an insurance company to raise their rates, they have to get permission from the State Department of Insurance. And oftentimes, depending on how much they're seeking to increase their rates, they have to open up their books, submit an application, and really demonstrate and explain why it is necessary. And in California, over the last several years, the state has made it very, very difficult for insurance carriers to raise their prices. Now, as is usually the case with well-intentioned, well-meaning policy, I don't think the insurance commissioner in California is intentionally, willfully making it more difficult for people, for homeowners, to get insurance coverage in the state. I think the intention of the policy is to try and keep costs down. But whenever you try to set these artificial limits on prices, what you end up doing is driving businesses away and reducing competition and reducing options for consumers. So when these insurance carriers have been going to the California Department of Insurance and requesting certain rate increases in order to keep up with the record high levels of inflation that we've been seeing over the last several years, the state of California was only allowing the insurance carriers to take into account historical loss rather than forward-looking projections of what their losses were likely to be based on increased building costs and catastrophe risks, and also based on the increased price of reinsurance. So basically, the state of California was saying, look, you can only increase your prices if you can demonstrate to us that it's necessary based on historical losses rather than what you expect your losses to be in the future. That is how insurance works. They have actuaries that are supposed to calculate risk, and they're trying to figure out what are the losses likely to be in the future. That's how you price insurance. So I can honestly say that until last weekend, I have never, ever argued with anyone on the internet. It's just not something that I see as being a productive use of time. However, I did somehow find myself in a little bit of a back and forth comment over the course of several hours last weekend with some people on Facebook. So this was a post in the Lab Coat Agents Facebook group. Someone made a post that said, quote, "The irony of the NFL moving the Rams-Viking playoff game to State Farm Stadium in Arizona due to the Los Angeles fires, just months after State Farm canceled 75,000 insurance policies for LA residents due to fire risk, is insane." And my comment was, quote, "State Farm didn't cancel the policies due to fire risk. They non-renewed the policies because the state of California wouldn't allow them to raise premiums enough to adequately account for the statistically likely claims expense of the fire risk." A lot of people are making State Farm out as a villain, when in reality, they just made the only logical business decision that they could based on the constraints created by politicians. Insurance companies are not a charity. They need to actually make money in order to continue to operate. So there were a lot of negative comments on this, and a lot of them seem to be disagreeing with my point and yet their arguments were contradictory to each other. So in one camp, we had a lot of people saying, this is just another example of a greedy insurance company putting profit over people, and they only pulled out of California because they want to make as much money as possible. Greedy big corporation, right? A lot of people don't know that State Farm is actually a mutual company, which means all of the profit goes to the policyholders. They don't have shareholders, but that's beside the point. So a lot of people over here are saying that this is State Farm being greedy, trying to make as much money as possible. And then there was another subset of people basically saying, no, that's inaccurate. When you say that they were losing money in California, that's just not true. They're making money in California. Both of these people disagree with my assessment, and yet their arguments kind of contradict each other. So think about it. If State Farm was making money, if they would continue to make money by selling policies in California, then why did they leave the state? The only logical reason for a company to stop selling its product or service is if it's not profitable to do so. If State Farm was being greedy, and if it was profitable to write homeowners insurance in California, they would have continued to write homeowners insurance in California. If it was profitable to do so, they wouldn't have left. So if anything, if you disagree and think that, well, no, there's no way that the state of California was making it impossible for insurance companies to be profitable in the state, but you also believe that these insurance companies are just greedy and only care about profit, then how do you explain the fact that all these insurance companies are pulling out of the state and stopping to write new policies and also non-renewing policies? Those two things just don't compute. All right, so this is according to S&P Global last year. This was a report that they did on State Farm's financial health and performance. Quote, we expect the overall combined ratio, which has been improving recently, to reach between 105% and 107% in 2024 and between 101 and 103% in 2025, with a natural catastrophe loss of around 8%. In 2023, the combined ratio improved slightly from 116.6% from 117.2%. In 2022, owing to management's efforts on profitable underwriting and increasing the prices for the personal lines. However, the higher loss severity, along with the total catastrophe loss of $9.5 billion in 2023, compared with $5.1 billion in 2022, affected overall performance, unquote. All right, so just to break this down, when you're looking at the performance of an insurance carrier, there are really two numbers to keep an eye on. There's the loss ratio and there's the combined ratio. So the loss ratio tells you for every dollar of premium taken in, how much is paid out in claims-related expenses. So if your loss ratio is 90%, that means for every dollar you collect in premiums, you're paying 90 cents out in actual claims to customers. So that's the loss ratio. Now the combined ratio it adds all of your other operating and financial expenses on top of that. So obviously these companies, their expenses are not just claims. They have office, they have staff, they have supplies, they have technology, they have interest payment, whatever. So all of the other expenses related to actually operating the company, other than paying claims, that's where you get the combined ratio. So in 2022, State Farm's combined ratio was over 117%, which means that for every dollar they collected in premiums from customers, they paid out $1.17 between claims and other operating expenses in order to keep the company running. In 2023, that improved slightly from 117% to 116%. And the projection was last year that they were going to end up somewhere in the neighborhood of between 105% and 107%. Anything over 100%, whenever you see a combined ratio over 100%, that means the company is losing money. So State Farm and many of these other P&C carriers have been bleeding money for years because a lot of the states are not allowing them to raise prices fast enough to keep up with costs. And that's the costs of the claims due to inflation and things like building materials. But it's also things like reinsurance expenses, wage increases, so they have to pay more for their staff. If wages go up 10%, but the state of California will only allow you to increase prices by 5%, that's a problem. So let's talk about inflation, because that really is the biggest driver of why insurance premiums need to naturally go up in order for these companies to continue to operate. So cumulative inflation over the last 4 years has been in excess of 21%. Now this is as measured by the Consumer Price Index from December of 2020 to December of 2024, the cumulative amount of inflation over that period of time has been over 21%, which means on average, consumers are paying 21% more for stuff than they were 4 years ago. However, the inflation for construction materials is even worse than that. So according to the Producer Price Index, construction materials prices were up about 40% since February of 2020, just before the pandemic. So if you're an insurance company that historically operates on about a 2% profit margin, and over the last 4 years, the cost of rebuilding homes that get destroyed by fire has gone up by 40%, but the state of California only allows you to raise prices by 7%, that is a problem. And that is the issue that we're seeing in California. What I believe to be well-intentioned policies of trying to keep prices low for consumers ends up driving these companies out of the state because, let's face it, if you operated a business and the state of California or whatever state would not allow you to raise your prices to keep up with inflation, and they were expecting you to continue to operate at a loss year after year after year, how long would you stay in that situation before you decided to stop doing business in that state? All right, so one of the other common comments that I got on this Facebook post last weekend was, think about how terrible this is for these families that have been paying their insurance premiums to State Farm for all these years. They've paid all this money in, and now they finally are in a situation where they need to make a claim, and they can't. One person said, if you've been paying money to your insurance company for 10 years and then they cancel your policy, you should get every penny back that you paid in premiums. And this is because people just don't understand how insurance works. So when you pay money to your insurance carrier, it's not like they have an account with your name on it where they're collecting your premiums and that money is just piling up for when they need to spend money on you. That's not how it works. They don't have just a savings account sitting there with your name on it. When you pay premiums into an insurance company, that money is put into a pool and then is used to pay the claims of whoever else is in that pool. So if you've got 1,000 people all paying, $1,000 a year in insurance premiums, that's $1 million a year in premiums that this company is collecting from those 1,000 different customers. If just one of those 1,000 people has a big claim that costs $1 million, all of that money was exhausted. Now you've got 999 people who paid their premiums and didn't, quote unquote, didn't get anything out of it that year from their insurance company. But that, again, that's just not how insurance works. Insurance is one of those things that you buy and you hope you never have to use. But even if you never have to file a claim, you are getting value out of having that policy. The transfer of risk is in itself valuable. The fact that if something would have happened during that period of time, you wouldn't have had to pay for it, or you wouldn't have had to pay for all of it. That in and of itself is the value that you received from that policy. So just because you have never had to make a claim doesn't mean that you didn't get value out of being a policyholder. And again, insurance is about pooled risks. The vast majority of people never have to make a claim or never make a big claim, but they take in the money from all these customers and then they use that money to pay the claims of the people who need it. All right, the last point I want to make about State Farm before we move on is that in the state of California, insurance carriers legally have to provide written notice at least 75 days in advance if they intend to non-renew a homeowner's insurance policy. So there's been a lot of misunderstanding about this. It's not like State Farm was watching the news and they saw these fires approach, so they just call everyone up and say, we're canceling your policy. It's not how it works. They made this announcement in March of last year, of 2024, saying that we were going to start non-renewing these 30,000 policies as they come up for renewal over the next 12 months. And the ones that were going to be affected, they had to give them legally in California, they had to provide 75 days written notice, which means that these homeowners had plenty of time to find an alternative. State Farm is not the only insurance carrier who has stopped doing business in California. We talked about Allstate and Farmers and others, AIG, Chubb. A lot of insurance carriers have pulled back from the California market because it just doesn't make financial sense for them to be there right now. However, there still are companies writing homeowners policies in California, Travelers, USAA, Geico, etc. So, anyone who was affected by this, they did have the opportunity to find a replacement policy. And keep in mind, homeowners insurance policies are typically a 12-month contract between the insurer and the insured. When you purchase a homeowner's insurance policy, you agree to pay a premium for the year, and the carrier agrees to cover you for that year. But neither party has to sign a new contract or renew that policy at the end of the 12 months. You as the consumer can decide every year to go get a different policy from a different carrier. And likewise, the carrier can also choose not to renew that policy if they feel like the price is no longer an accurate reflection of the risk. However, there is a certain amount of time they have to give you notice, and in the state of California, that is 75 days. So again, please don't take what I'm saying as, I don't want to cast blame on these people that are in these terrible situations. Again, I feel for you. I'm empathetic. If you lost your home in a fire in California and you didn't have insurance, that is terrible. I can't imagine what that would feel like. But again, a lot of people are rushing to cast State Farm as this big evil villain, when in reality, my personal opinion is that they made the decision to pull out of doing business in California after years and years of losses, and their forward-looking projections saying that it is not going to be profitable for us to continue to write these policies. And they followed all the laws. They gave the consumers enough notice. The consumers had the option to go get coverage with another company. And I don't want to make this too political, so I'm not even going to go into, what the state of California has or hasn't done to be prepared for these fires, whether it's, not building enough reservoirs and not having enough water, not cleaning up the forest to help, prevent these types of situations. The things at the local level, like the budget for the fire department in Los Angeles specifically. I'm not going to get into all that. All right, so shifting gears, it's been a bit of a crazy week here for mortgage rates. We had a very stronger than expected jobs report for December, which sent mortgage rates up. And then shortly thereafter, we had a rather benign inflation report and mortgage rates tumbled. So this is according to the Wall Street Journal. Quote, Treasury yields in the dollar fall as December inflation is in line with expectations. Headline 12-month CPI is 2.9%, up from November's 2.7%, but meeting consensus forecast in a Wall Street Journal survey. The core reading is 3.2%, while surveyed economists expected a repeat of November's 3.3% pace. The results could ease fears that the Fed might need to be even more hawkish than it signaled in December. Yields were already trending lower and deepened their losses after the data, unquote. And this is according to Housing Wire. Quote, housing markets across the country that have faced persistently high home prices may be getting a break. Core inflation outside of volatile food and energy costs, increased 0.2% relative to last month, which is a slower pace than the 0.3% month-over-month rises experienced over the last 4 months. And most important for the housing industry, shelter costs rose by 4.6%, which is the slowest pace of housing cost increases in 3 years. For context, it peaked at 8.2% in March of 2023. The conquering of inflation will be a key factor in bringing down the mortgage rates, which so far have refused to budge even as the Federal Reserve has been cutting other interest rates, said National Association of Realtors Chief Economist Lawrence Yun in a statement. Various non-official private sector data are pointing towards no growth in apartment rents due to the vast oversupply of new empty units hitting the market. Mortgage rates will move slightly lower, perhaps to 6.5%, just in time for the spring home buying season, unquote. So what's interesting there is the inflation report wasn't necessarily great news, but mortgage rates went down pretty significantly nonetheless. So I think part of that is maybe the markets realized that there was a bit of an overreaction to the jobs reports and yields went a lot higher than people expected. So, even as the article says, yields were already trending down from that high before we got the inflation data. And so once we saw that the inflation was kind of in line with economists' expectations, they took that as good news, and mortgage rates dropped fairly significantly, along with yields on other types of debt securities. All right, so let's talk about the Supreme Court. So according to Real Estate News, quote, today the High Court has announced its decision. It will not take the case, leaving in place a judgment made by the U.S. Court of Appeals last April, allowing the DOJ to continue investigating the association, unquote. So just for context, and we've talked about this a few times on the show. So back in 2020, the DOJ, Department of Justice, opened an investigation into NAR, National Association of Realtors, focused on a couple things. So the participation rule and the clear cooperation policy. Participation rule said that in order to list a property in the MLS, you had to offer to cooperate and compensate a buyer's agent. That's now a moot point. That rule has been done away with as part of the NAR settlement. But the other part here is the clear cooperation policy, which says that realtors, members of NAR, cannot do any public marketing of a listing without also submitting it to the MLS within 1 business day. So the DOJ had investigated NAR for that. They reached a settlement agreement in 2020 when Donald Trump was still in his first term. And then in 2021, after the administration changed hands, we had a new DOJ. The DOJ decided to withdraw from that settlement agreement and reopen their investigation. Well, of course, NAR sued. Originally, a lower court upheld the settlement and said, no, DOJ, you can't do that. You can't just reopen an investigation that you entered into a settlement agreement to close after extracting some concessions from NAR. You can't do that. People need to be able to trust the government just like any other party. When you sign a settlement, when you sign a contract, you got to honor it. So that was the original decision by a lower court. But then the DOJ appealed that, and the appeals court then sided with the DOJ and said, yes, you can reopen the investigation. Well, NAR appealed that and was seeking to escalate it all the way up to the Supreme Court, hoping that the Supreme Court would overrule the appeals court decision and side with the lower court and force the DOJ to abide by the terms of that settlement and not reopen its investigation. However, as expected, unfortunately, the Supreme Court did not agree to take up the case. The Supreme Court is very, very busy. They've got a lot of cases on their plate, and they only take up a very small percentage each year of the cases that people would like to bring. So the Supreme Court is not going to hear the case, which means that the appeals court decision in the DOJ's favor is going to stand, and the DOJ is now free to reopen its investigation of NAR. All right, so we've got the latest victim of the CFPB. So this is Vanderbilt Mortgage. They are the latest recipient of enforcement action. This is according to Inman. Quote, a mortgage lender that specializes in providing financing for manufactured homes has landed in hot water with federal regulators who claim the company saddled borrowers in the greatest need with mortgages that they couldn't reasonably afford to repay. Maryville, Tennessee-based Vanderbilt Mortgage and Finance, which also does business as Silverton Mortgage, is accused of violating the Truth in Lending Act and Regulation Z. Reg Z requires that all mortgage lenders document and verify borrowers' income to determine whether they have the ability to repay the loan they're applying for. I know, go figure. Lenders actually need to verify that people can make their mortgage payments. Vanderbilt, which mostly provides financing for homes built by its parent company, Clayton Homes, quote, ignored clear and obvious red flags that certain consumers would not be able to repay their loans according to their terms, unquote. The Consumer Financial Protection Bureau alleged in a January 6 complaint. In a statement provided to Inman, Vanderbilt characterized the CFPB's allegations as, quote, unfounded and untrue, and the latest example of a politically motivated regulatory overreach, unquote. Vanderbilt said that the CFPB examined tens of thousands of loans and identified less than 0.8% over a 6-year period that allegedly should not have been made. Vanderbilt, quote, follows the law and the facts bear that out, the company said. So that remains to be seen. This is just the latest example of the CFPB taking enforcement action. They have been very aggressive lately in coming after these companies. So you remember maybe a couple weeks ago on the show, we talked about the CFPB suing Rocket Homes over that alleged kickback scheme where they were trying to steer people over to their sister company, Rocket Mortgage. So we're going to be following these cases, and we will give you updates as we have them. All right, last but not least, I want to talk about this TikTok ban. So a lot of you guys might use TikTok for your business, and so this is something you need to be aware of. So according to RIS Media, quote, in April 2024, President Joe Biden signed a bill mandating TikTok's parent company, ByteDance, divest from the app, or else it will be functionally banned in the U.S. starting January 19th of 2025. What does the ban look like? While there's little precedent for the government to ban a major social media platform, expectations are that companies who control app stores, such as Google and Apple, will remove TikTok from their platforms so that new users cannot download it onto their devices. TikTok would most likely not be removed from existing users' devices, but they would not be able to update it anymore, so the app could eventually become unusable. ByteDance is based in China, and the pervasiveness of TikTok has produced international controversy, which claims, including from a former employee, that the Chinese government is able to spy on TikTok's user data. TikTok has denied any such links to the Chinese government. In a March 2023 congressional hearing, the company's CEO, I'm not going to try to pronounce that, a Singaporean citizen, maintained that U.S. TikTok users' data is well secured. Opponents of the ban, including TikTok itself, have argued that it is an overreach that infringes on freedom of speech. All right, so let's unpack this a little bit. So TikTok, very popular social media app, it's owned by a company called ByteDance, which is a Chinese company. Now, the US, for national security reasons, has said in order for TikTok to remain functional in the United States, we want ByteDance, this Chinese company, to sell TikTok either to an American company or maybe a company that's more aligned with the United States. So if you are a real estate agent who uses TikTok very extensively and that's your primary source of business, you need to have some alternative options in mind. Maybe Instagram, Facebook, YouTube, there are some of these other apps that are popping up. But if you rely too heavily on TikTok, you might want to start rethinking that strategy and kind of diversify and make sure that you're using these other social media platforms as a way of generating leads. All right, we're going to wrap up with a segment called Ask Me Anything. This is where you guys ask questions and I answer them, hence the name. I know, it's very clever. So if you have a question that you'd like me to answer on the podcast, you can send an email to hello@realestatebackstage.com. Now, this week's question comes from Chris. Chris asks, quote, why is it that good news with the economy leads to bad news with mortgage rates? That is a great question. So let's unpack this a little bit. Mortgage rates are driven by markets. They're not set by the Federal Reserve, okay? The rates that you pay for your mortgage are driven by the yields on mortgage-backed securities, which trade on the open market, just like stocks or any other type of securities. So if we have good news in the economy, we have a strong jobs report, we have good GDP growth, good news for the economy is growing, things are going great, investors tend to get very optimistic and they tend to put their money into the stock market, okay? So when we have good economic news, we tend to see the stock market go up. Now, when we have bad economic news, people tend to sell their stocks. They get pessimistic, okay? If we get a not so good jobs report, if we see the economic growth rate coming down, or maybe even we see GDP shrinking, bad news in the economy, investors get skittish. They pull their money out of stocks, so they sell their stocks, which causes stock prices to go down. And then they put that money into what they deem to be more safe, okay? Sometimes that's treasury bonds. Sometimes that's other corporate bonds. And sometimes it's things like mortgage-backed securities, okay? So these are fixed income debt instruments. And there's an inverse relationship between price and yield. So as more people are moving their money into bonds and purchasing bonds, there's now additional demand for mortgage-backed securities that's going to drive the price up. But if those fixed payments don't change, then your effective yield is going down. So if that mortgage-backed security is paying out 5% annual payments based on the original face value, but now the price of that bond is higher than the face value, your effective yield is going to be lower. And the reverse is true. As people are pulling money out of mortgage-backed securities and other bonds, the price of those bonds will go down. And as the price goes below the original face value, that regular income payment now creates a higher effective yield on that security. So that's why we see good news in the economy tends to mean positive movement in the stock market, but negative movement on yields in the bond market. And the reverse is true as well. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with links to all the articles we referenced at realestatebackstage.com/episode 14. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.